Okay, and welcome back, students who are taking financial accounting. In this series of videos, we are going to be doing the theory portion of Chapter 7, which is on cash and receivables. There's going to be somewhat a lot to cover. Some stuff I'm just not going to cover, and I'll point that out. But there is going to be some subject matter, about half of the chapter I'm actually going to cover in these videos. So I don't know exactly how many it's going to take. We'll just see, however many it takes as to when I get there. Okay. Let me get my pen. All right. And, in this chapter, we're going to talk about sales. I'm going to talk about the purchases and payment process. We'll cover bank reconciliations. We'll cover accounts receivable as uncollectible accounts using the direct write-off method or allowance method. Estimating the amount of the uncollectible accounts using the percentage of sales method and the aging method. We'll talk about notes receivable. Of course, we have our focus on decision-making section. And also, we have two appendixes. The time value of money, which is at the end of the textbook, and the petty cash fund, which is an appendix to Chapter 7 in and of itself. All right, so just as a quick heads up, I know I'm not going to spend much time on sales. I'm not even going to spend any time on bank reconciliations, and I won't spend that much time on the time value of money. I will spend a little bit more time on the uncollectible accounts. So with that said, let me just get to it and see where we end up. Right, so with sales, I'm not going to spend that much. Read it in the textbook, but reality is that when you make a sale, you're making it with cash. They're going to use a debit card or a credit card. You're going to make sales and have them as an accounts receivable on account. This stuff you should already be familiar with. The only thing that you might not be familiar with is the credit and debit card. So if you let's say you make a sale and somebody's using a debit or a credit card, and I realize that this is not covered extensively in the textbook, all right, because of the way it can be handled. But obviously you're going to credit your revenue account, your sales revenue account. Let's just say it's for $100, and you would debit a credit receivable account, or you can also credit your accounts receivable, because you're using that credit or debit card as a form of payment. Realize that when you're dealing with credit cards, it becomes a lot more complicated, in that if you go and you say, okay, look at they're going to purchase on with a credit card, and the reality is that you don't get the money immediately. Okay, yeah, you run it through the machine, and the machine says, yeah, it's the bank is going to accept that as payment, but you haven't actually received that money yet. Later on in the month, you will receive a check from the bank itself in the amount of all of the credit sales that have occurred for a period of time. And so it's different businesses will handle how they handle those credit sales, whether they'll have like I said, a credit receivable account, or they'll have an accounts receivable that will be called credit sales. Okay. That's the easiest way to go about doing it, because by having that accounts receivable account, and let's say over the course of the 30 days, you do $15,000 in sales. Okay, well, your accounts receivable is going to be the $15,000, and then when the bank sends a check, when the bank sends the check, you'll apply that check against that accounts receivable. Okay, and of course, you're always going to have a running balance in that accounts receivable account, and you're always going to have to be reconciling it to make sure that it is correct. So just be aware that when it comes to credit sales, there's more than one way of doing it, but it'll all depend upon how you want, how it's being done in your particular business. But a common way, like I said, is using the accounts receivable. I mean, you can create a credit receivable account and treat that the same as an accounts receivable. So your chart of accounts would have cash, then you'd have petty cash, then you'd have your accounts receivable, and you'd have your credit receivable. Okay, so that could be a general ledger account in and of itself, or like I said, a lot of times as part of the accounts receivable, one of the customer accounts will be a credit sales account, and that's what will be used because it's having the credit card or the debit card is in essence like doing an accounts receivable. It's just a different form of payment. That's when someone buys something saying they want to use the credit card, you're running it through the machine, and the machine, the bank says, okay, we'll accept that as payment, but you still haven't gotten the money yet. So the customer walks out with the product. You have a promise from the bank that they'll pay, and of course, 30 days later, you'll receive that check in the mail, or whenever the bank sends that, and you have to reconcile it to that account. So you're not really, you're not reconciling individual customers that are using credit cards. What you're doing is you're reconciling the total of the credit sales. You might have 50 customers that have used a credit card. Well, you're not keeping track of 50 customers. You're keeping track of, the 75 for 100 transactions and the total amount that those transactions were worth, and that's what you're getting back, the check from the bank in and of itself. So for sales, that's kind of like, you know how to do cash, and you should know how to do accounts receivable by now. But the credit and debit card is, I mean, it's there. It's being used in the workplace nowadays. So you have to kind of know how to work with that. And of course, you have to consider internal control when you're talking about sales. The accounts receivable clerk should not be the one handling the cash. Okay, the accounts receivable bookkeeper should not handle the cash. You should have a separate person that handles the cash, so there's a separation of duties. And so that no embezzlement or less of a chance for embezzlement to be occurring. Okay, purchases and payment process. And the reason why, I copied this out of the book, but unless you're in the environment, you don't really realize what goes on when it comes to purchases. Meaning purchases, you're the business and you're buying something from the vendors. Okay, let's say you have a maintenance department. Okay, well, they're not going to keep on running to you saying, oh, can I buy this? Can I buy that? Can I buy this? Can I buy that? No, what they do is they have a pad of purchase orders, and those purchase orders are numbered. Okay, remember, as an internal control, you number all of your documentation. So they have this purchase order, and the purchase order has several different copies, 5, 6, 7 copies that they actually have to when they're filling out that purchase order, they have to press heavy so that it goes through all of the copies, because the copies go to different people. They keep one for themselves in the maintenance department. Okay. They actually, and since they're carrying that purchase order and they're going to the supplier, okay, they give the supplier a copy. Okay. so let's say they're picking up these supplies in the amount of, say, $250. So the supplier gets that purchase order because that purchase order that they get is what they use in order to invoice, create their invoice that becomes our accounts payable, right? The maintenance people come back to the company with the $250 in merchandise, and they give, they have the supplier actually sign off on it, sign their name saying that, that they've received it, and they give a copy of it to you, the bookkeeper, or you in accounting. Okay. Now the supplier, as you can see, that merchandise inventory, comes to the company, whether it goes to the maintenance people or it ends up going into, inventory. But the whole idea here is that the bookkeeper or the accountant is taking that purchase order and they're matching it up to whatever shows up on the invoice. So in other words, if they have that purchase order says, I want 10 of this, 5 of that, 6 of that, and 7 of that, right? So that's 11, 8, there's 28 items on that purchase order. And of course, the maintenance guy is getting those 28 items at a total cost of $250. Now, those items, end up in the business, whether it's in our inventory or it ends up in, the maintenance department to be used. But the bookkeeper is taking that purchase order and they're making sure that those items were received. And of course, the supplier, they're then going to invoice the company. So when the invoice is received, the bookkeeper is going to match up that purchase order with that invoice to make sure that it is correct. Any discrepancies that happen along the way in this process have to be looked at and taken care of. And again, that's all part of internal control, right? You have a separation of duties, all right, and you have paperwork that's numbered, and you have the documentation, the numbered documentation, in order to be able to account for everything that's going on. So now the company has, they have the merchandise, they have the purchase order, they have the invoice, and the company, it says here, shows a receiving report. I don't know that many companies that actually use receiving a report, but it all depends. It's possible, all right, that they want to show on the report what actually has been received. I mean, you're talking about multiple departments that use the same materials that might use a receiving report. But the bottom line being is that once the accounting office has the invoice, they have the purchase order, they'll cut a check and then send the money to the supplier, to the vendor, and the transaction is concluded. So in doing the purchases, you end up using accounts payable, okay, when you get the invoice, right? So you're going to, debit, supplies expense or purchases or whatever, and you'll end up crediting accounts payable when you receive that invoice, okay? And then of course, when you go ahead and pay it, you're going to, credit your cash and debit that accounts payable in order to clear it off the books, okay? So, this here illustration, it has all of the pieces in it, but I thought I'd point out, what this process how this process goes, because the main thing here is this purchase order, okay? And remember, this purchase order, it's what starts everything, and there's multiple copies of it, and those copies get distributed to all the important players in the transactions. Okay, the supplier gets a copy, the maintenance gets a copy, the accountant gets a copy. If another department or it needs to be attached to a receiving report, it gets a copy. But that purchase order is what drives everything. What's written on there is what should be received. If it's, if there has to be a change made to that purchase order, generally they do one of two things. They either issue a new purchase order or they scrap the old one and they rewrite the purchase order, but they're always numbered, all right? And it has to be, if you decide to void that purchase order, it doesn't just get tore up and thrown into the waste paper basket. No, that purchase order with that number ends up in the accounting office because, in the drawer in the file, all of those purchase orders should be, in a numbered sequence. So the people in the accounting office, the bookkeeper, not only are they going to attach the purchase order to the invoice, but they're also going to use one of those copies in order to keep a sequence of those purchase orders to know that none were just tossed to the side. If there's a missing purchase order, then that's a possibility. It allows for the possibility of theft, which they don't want to occur. Okay, so that's purchases. Now I'm going to move on to, and I'll quickly cover the bank reconciliation here, and then I'll end this video and we'll pick up with uncollectible accounts in the next video. I only have one slide here for the bank reconciliation. Okay, you can read about how to do this in the chapter, but the vast majority of students taking financial accounting have already had math for business and finance or math applications. Okay, so doing the bank reconciliation is not new. Okay, if you had it in that subject, you should know what, you should be able to do this in this chapter. So this here is a repeat of, information that is important. Now, I'm not going to go back through all of this in this video. Okay, if you need more help, pause this video and go out to the student community and go to this web address. Okay. There's videos there, and this is for students who have taken math for business and applications. You can watch the videos, supplemental videos, and when I made the videos, I actually provided the additional, data and whatever have you. So you don't need the textbook in order to be able to watch those videos on how to do the bank reconciliation. All right, you can actually just watch the videos themselves and glean the information. And even though it's in math for business or business and finance or for math applications, it's a bank reconciliation is a bank reconciliation. It doesn't change just because you change subjects. So if you're if you haven't had those subjects, or if you forgot, okay, well then read through the chapter, study the material in the chapter, and then go and watch those videos on the student community under Math for Business / applications. There's theory videos, which will explain the process, and then there's also assigned homework problems. Okay, so and again, the assigned homework problems, you don't need the textbook because I put the data right in the video. So you can start the video, look at the data, work through the problem, pause the video, work through the problems, and then double check your work by watching the rest of the video. And that also leads us to this here with for chapter 7, okay, in the financial accounting textbook. Yeah, you have the information in the textbook, but I am going to be working through the homework problems, okay? And working through the homework problems, there are there's a few that you have to do the bank reconciliations. So if you go to this web address, you can watch me work, you will work through the problem and then watch those videos to see if, how it was done if you don't arrive at the correct answer. So I'm not going to repeat, spend another hour, 2 hours, or however 3 or 4 hours repeating myself on doing these bank reconciliations when these have already been covered in other videos in the Math for Business and Math Application section of the student community. Okay, and again, if you read the chapter and you're new to it or you forgot and you're trying to study and remember now, read the chapter, understand, try to understand what's in the chapter. If you don't understand it, then feel free to contact an instructor. But when you're doing the homework problems, that's the application aspect of it. So try to work through the problem. If you get the answer, great. If you don't get the answer, watch how it's worked out. And if you still don't understand how it's worked out, then reread the chapter, go back and watch, the Math for Business, Math Applications videos under Chapter 4. And if you still don't get it, you still don't understand how a bank reconciliation works, then definitely telephone and speak with an instructor. Okay, so that's it for this video, and I will pick up working on the uncollectible accounts in the next video.